Hey everyone, welcome back to the channel. If you're someone who gets a regular paycheck and wants to invest wisely, today's video is just for you. We're diving into a strategy called dollar cost averaging, or DCA for short. This method is all about consistently investing a portion of your salary each month, no matter what the market is doing. Sound interesting? Let's break it down. So, what exactly is dollar cost averaging? It's a straightforward investment strategy where you invest a fixed amount of money at regular intervals, like every time you get your salary. The beauty of this approach is that you don't have to worry about timing the market. Instead, you're spreading out your purchases over time, which can help you avoid the risks of market volatility. Whether the market is up or down, you're buying in. This means you purchase more shares when prices are low and fewer when prices are high, effectively averaging out the cost of your investments over time. Now let's talk about why this strategy works. Markets are unpredictable. They go up, they go down, and sometimes they just move sideways. Trying to predict these movements can be stressful and frankly, nearly impossible. Dollar cost averaging takes the guesswork out of investing. By investing the same amount of money each month, you reduce the impact of short-term market fluctuations. Over time, this approach can lead to a lower average cost per share compared to if you tried to time your investments perfectly. Plus, it's a great way to stay disciplined and consistent with your investing. Alright, let's get practical. How do you start dollar cost averaging with your salary? First, determine how much you can comfortably invest each month. This amount should be something you can commit to consistently without straining your budget. Once you have that number, decide where to invest it. Some popular choices include broad market index funds, ETFs, or even individual stocks if you have a long-term conviction. The key is to automate the process. Set up automatic transfers from your bank account to your investment account right after you receive your salary. This way you won't even have to think about it. It's investing on autopilot. Remember, the goal is consistency. Whether the market is booming or dipping, you stick to your plan and keep investing that same amount. Over time, this habit can lead to substantial growth in your investment portfolio. Let's look at a quick example. Imagine you decide to invest $500 from your salary each month. In January, the stock price is $50, so you buy 10 shares. In February, the price drops to $40, so your $500 buys you 12.5 shares. In March, the price rises to $60, so you buy around 8.3 shares. By April, the price is back to $50, and you buy 10 shares again. Over these 4 months, you've invested $2,000 and accumulated around 40.8 shares. The average price per share you paid is lower than the average market price over those months. This is how dollar cost averaging can benefit you over time. Now, dollar cost averaging isn't a perfect strategy, and it's important to know both the pros and cons. The pros? It's simple, removes emotions from investing, and helps you take advantage of market dips. It's also a great way to build wealth gradually without needing a large lump sum to start. But there are cons too. If the market rises consistently, you might end up buying at higher prices, missing out on gains if you had invested a lump sum early. And while DCA is effective for volatile markets, it may not maximize returns in a consistently bullish market. To wrap it up, dollar cost averaging is a solid strategy, especially for those of us who receive a regular salary and want to invest consistently without the stress of market timing. It's a method that's all about discipline, patience, and taking the long view on your financial future. If you found this video helpful, please give it a thumbs up and don't forget to subscribe for more content like this. Hit the bell icon so you never miss an update. Thanks for watching, and until next time, happy investing.